is back with us. You have Scott Martin, who definitely does not want to see the Saints win this weekend. He's the managing director of Astra Asset Management in Chicago. We can talk to him a little bit about football. Is Keenan with us, guys, as well? There he is.
I'm
nice
here.
To see you, Keenan.
Good morning, Jenna.
Hey, Charles.
Hey, how's it going, Keenan?
I know you were here last
Great.
hour, but congratulations again. We know you had a new addition to the family, a new adoption of your son.
Thank you. Thank you. And then you'll be congratulating me Monday morning with a Colts victory, too.
Very good.
I'm with that.
All right, so let's talk a little bit about these markets. Thank goodness we have the Super Bowl to look forward to, because if it was just the markets, we might not feel so great about this. Keenan, starting off with you, there's an interesting editorial in the Wall Street Journal today by Nouriel Roubini and Ian Bremmer. And what they basically sum up is that investors have suddenly become aware with this global debt issue that is still hanging over us. Do you see what's happened in the markets over the last couple days as a reckoning with reality, or is there something else going on?
No, I think there's something else going on. It's nothing more, in my opinion, than what we see during bull markets, which are corrections that can go 8%, 10, 12%, and they come every few months. Look back to June and July of 2009. The Dow fell 9%, and then it was off to the races again. And then we saw two corrections in the fall, in September and again in late October. And it was off to the races again. I'm not sure this is going to be as quick of a recovery. I think we can see a few more months of a consolidation period. I'd like investors to go back to 2004. From February to August of 2004, the market was caught in this 8% range after a great 2003. We look to be building some kind of a similar situation right now, but it wasn't the top. We don't think that we've seen the top in the equity market from the March 09 low.
Now, do you think that we've seen a bottom, though? And we already bottomed out on this market from this recession?
No. I mean, right. To nail an exact bottom day, that's not my skill set, and I don't know if anyone has that. No, the markets could have another 2, 3, maybe even 4% risk in the downside, depending on which market you're looking at. But we're closer to a bottom than we are to a top, and I think investors should be looking right now, right this second, as looking around to start buying. Yes.
Well, Scott, that sounds like a very similar scenario to what we saw last year at the same time, where the markets were just bumping along the bottom there, at least for that year, until the end of March. Do you see a repeat of last year, that sort of pattern repeating itself, Scott?
I don't know, Jenna, if we're going to get so much selling, like Keenan said. I mean, I think we're going to get these corrections that are just part of the bull run. I mean, certainly, Jenna, when you're positioning portfolios, right? I mean, even talking about Toyota already this morning, you want to buy when people are selling. You don't want to buy when other people are buying, because the price would be going up and you're chasing performance. And so when people want to dump things, like, Jenna, what's going on in the markets right now is you're seeing a lot of the crowded trades, right? The stuff against the dollar, the commodities, the oils, the emerging markets, all getting dumped at once. Those are the times to come in and scoop those, because you're getting those sellers out of there right away.
Charles, I got one of those emails that I haven't gotten in a long time last night from a family friend that wrote me and said, what happened with the markets? What's going on? I'm really worried again all of a sudden. And we used to get those emails all the time, really a year ago, with family, friends, everybody just feeling like, what am I going to do with my portfolio? And that's the first one I've gotten in a while. If you got that email, what would you tell that person?
Well, you know what? It's so funny, because I've been getting letters and emails, and in part because I do the radio show too. And it's an interesting group of people who seem to be particularly afraid. I say 55 and over.
Because that's exactly the range that it was in.
A year ago, they saw so much of their life's work almost go completely away. A lot of it came back, but they're still down, and they're wondering, can they go through this again? Should they get out, lick their wounds now? People right now, I mean, it's easier to talk about, buying these dips as a longer-term investor. But there are a group of people right now out there who are definitely afraid that, they can't go through another one of these major, where we hit this incredible air pocket, particularly because these same people share concerns about the direction of the country in terms of monetary and fiscal policy. Look at some of these countries that have really been a driving force of the global weakness this week. Spain, Portugal, Hungary, Greece, all socialist countries, all with similar deficits to GDP ratios that we have now.
Charles, I'm going to go around the circle. I'm going to start off with you, because you mentioned all of these issues that are causing a lot of anxiety. So if someone can do one thing with their portfolio today, and I'll ask Scott and Keenan the same question, what do they do? What's the one thing they should watch for today, and what's the one action they should take? Charles, let's start.
The one thing I think people should do, and periodically, and I don't think they do enough, and I blame the industry a lot for this, the idea you just keep buying a bunch of stocks and mutual funds and you just keep adding to it. there are times to prune out, the losers and winners. We're going through an earnings season. You can see companies that are losing market share. Last year, same tide lifted all ships. I think this year is going to be more selective. The companies that are taking market share are going to do very well. If you're one of these companies that's losing market share, don't just hold the stock for holding the stock's sake.
Scott?
Yeah, I agree, and I think, Jenna, it is going to be a kind of a more stock pickers or, say, sector pickers market this year. And I'll tell you what, guys, I'm a big fan of the dollar this year, both in the sense that I think the dollar is going to strengthen and because it's just not correlated to equities. And so when you're bouncing around these bottoms and whether, today's the bottom or yesterday or next week or the week after, the dollar seems to have some footing underneath it. And so the fact that I like adding the dollar to a portfolio just as kind of a hedge and a sector or a style play that's going to go up, I think, over the course of the year is a great addition to a portfolio. And you can buy it in an ETF. The UUP is one thing we've used to put in our portfolios so far.
And Keenan, final thoughts. I know you're pouring over your technical charts. What are they telling you?
Well, they're telling us that we haven't seen the highs of the run, so therefore investors should be willing and ready to buy stocks during dips. We've transitioned away from the easy money in 2009, however, which means that you don't want to be chasing rallies. Don't buy stocks after they've broken out and gone up for several weeks. Buy situations like you see right now, and then after many weeks of runs, be willing to take some profits because we're going to see a little more deeper corrections and corrections that last for more than a few days. But we don't think we've seen the highs, so get ready to do some buying.
All right, Keenan Hauke, he's the CEO of Samex Capital Advisors, also a Colts fan. So is Scott Martin. He's going to be back with us as well. And Charles, you got to pick on the Super Bowl?
I'm rooting with the Colts. I'm not going to go against you guys here.
There you go, Charles.
You got
Appreciate that.
All right.